thank you everyone for joining today's webinar. My name is Rishi Shah, and I am VP of Product here at YCharts. And we are lucky enough to have our friend Nick Maggiulli here on the call with us. Nick is Chief Operating Officer at Ritholtz Wealth. He also has a blog that is phenomenal called Dollars and Data. And then he's also the author of one of my favorite books, Just Keep Buying. And we're going to use a lot of the data and thoughts he's had in that book today with YCharts as well. So just a few housekeeping items before we kick things off here. We are on a Zoom call, so there is a Q&A at the bottom of the screen. Feel free to throw questions in there, and Nick and I will be able to handle those throughout the call, some at the end. And if we don't get to it, we will definitely get back to you on your questions. If you are on the call, or if you registered, we will be sending you a recording of this webinar too. So if you're interested in checking things out, feel free to watch that recording. Feel free to subscribe to our YouTube channel as well. We have a lot of great webinars and other resources there, just like this one. And lastly, throughout our presentation here, our team is getting high tech here. We have a QR code in the top right of the slide. So feel free to scan that. It'll take you right to our trial page where you can sign up and check out YCharts yourself. Lastly, please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. All right, with all that out of the way, let's get going, Nick. How's your day going?
Good. It's been good so far. Just getting things going, and excited for this webinar midday. So
yeah, let's get into it. We're going to spend a lot of time today on our YCharts Scenarios tool, which is relatively new. It's been out on YCharts for about 6-7 months now, and we're seeing a lot of great use cases there. And we're going to talk about a lot of those from an advisor's lens today. And so just a quick agenda before we jump into it. We're going to talk about 3 different stages of life that a lot of clients of advisors go through. That first stage being the importance of investing early, or actually making that decision to join your advisory firm or actually start investing. We know that's a big part of gaining AUM and having that conversation. The next part, we'll talk about that accumulation stage in life. So once you have started investing, what are some questions that commonly come up? And we'll use the scenarios tool to cover those. And then lastly, just getting to that retirement stage, and what are some common questions there? How can you use the scenarios tool to talk through those? That will be the last portion of the webinar, with Q&A at the end too. So with that, let's start with the importance of starting investing. So I wanted to start with the tweet that kind of gave us the idea of this webinar and why we wanted to do this using the scenarios tool. So Nick, this is one of your tweets, and it talks about basically just the fact that you should invest $100 a month, or if you did during this time frame, this was your return or your end value. You want to touch a little bit on how you thought of this tweet and why it was so popular with your following?
Yeah, so I was using the YCharts Scenarios tool, and I was like, you know what, like everyone's talking about how bad the market's down right now, and it definitely is. Let's be honest, but I was like, what about someone that had just started investing at the beginning of this bad market, right? If you had just started putting money in at the beginning of 2022, Jan 2022, where would your portfolio be? And I said, let's just say you put $100 a month in, and over this time period by Feb 23, obviously the market is down as a whole, but you're still up slightly, very slightly, at least in nominal terms. In real terms, you'd be down a little bit, right? But I think it's a good illustration that like people who are buying over time generally experience a very different pattern or a very different performance than someone who's just looking at snapshots. And almost everything we look at in the investment literature and out there in investment content is snapshots. It's if I put $10,000 in at this point and then I just waited, here's what I would have, right? And that's useful for a lot of people who are like retired and things who really aren't adding money. But most people aren't like that. Even people in retirement, technically, some of those add money from Social Security, or they can add money from their, required minimum distributions, et cetera. A lot of people are still buying over time, even retirees, believe it or not. So when you actually look at the data, most people are accumulating over time. And because of that, you're more likely to see something like this, a performance where even when the market's down, you can still be up a little on net. So that's something to keep in mind. And this is why, I love this tool, because you can see, hey, here's how much money I put in every point in time, and here's where my portfolio value is, and you kind of track against that.
Yeah, definitely. And in a lot of the examples we'll use today, we'll kind of cover that point you just made of, it's nice to say all this, like using an exact point in time, but maybe looking for during a 15-year, 30-year time frame, a lot of those points become more and more relatable to people that are thinking about that long-term horizon. Mm-hmm. So let's get into the tool. I'm going to go into my YCharts dashboard here and jump right into the scenarios tool. You can find it by hovering over tools, clicking on scenarios. And all the inputs here are on the left. So for the purpose of this webinar, I have all my scenarios saved down. You could do the same too within your account. That's the way you want to set it up. It's really easy to just open them up on the fly. And we're going to start with the concept of getting your client to start investing, right? And the point I wanted to make for this one is basically the difference between investing for 20 years versus 30 years. So it's this concept of, there's a saying that for investing, it's more important to have time in the market versus timing the market. So let's just look at the S&P 500. And I have that for 30 years here, and an initial investment of $10,000, and then monthly contributions of $1,000 for the rest of time. And let's compare that over a 30-year time frame versus a 20-year time frame. So you'll notice here in this top chart, you have that 30-year time frame up around 2 million at the end, and then the 20-year time frame around 850,000. So Nick, what are you seeing here? What's the big takeaway on this visual?
I mean, the takeaway shows is the level of compounding, right? Starting 10 years sooner, and you get literally over double the value, right? And so if you think about the contributions, right, you've only put in, 1/3 more over a 30-year time frame. You put in 1/3 more of the contributions, but you get over double the value. It really shows the power of compounding in a very useful way. And I think this is a good way to start. But people are like, oh, that's kind of obvious, isn't it? Of course, if you start earlier, but even there's going to be people out there like, you know what, I don't want to save yet. I'm going to wait and I'm going to save more. I'll just wait and, I'll just cut back now. And then in the future, I'll save more. That's something people might say. And I think even in those scenarios, you'll see that even by waiting and trying to save more, you'll actually still won't be able to catch up to kind of where you were at. And I think that's kind of also interesting and something we can do in this tool. I mean, do you want to, talk about that a little bit, Rushi? Yeah,
for sure. And I think the stat that I remember reading, maybe it was on one of your blog posts, about the fact that, the S&P 500 tends to double every, 7 years based on that certain return rate. So to your point, when you're playing catch up, it's pretty difficult to do that once you're 10 years behind, right?
Yeah, exactly.
Awesome. So that could be a great one to show your clients. Another topic that I wanted to cover for this stage of your life is the concept of dollar cost averaging versus lump sum investing. So let's say your client comes in and maybe they just sold a company, or maybe they just got some type of payment from a succession or something like that. And so you've talked about this concept of the difference between dollar cost averaging and lump sum. So let's look at this last year. So I'm going to look at let's open up this scenario, and basically what I'm doing is I'm comparing the S&P 500, but I'm comparing putting all your money in right away, which would be $1 million, or initially starting with 100,000, and then throughout the next 10 or 9 months, you would put in 100,000 more. So you're kind of leading up to that $1 million value, which last year it actually detracted a little bit from there. But what's the point here of the difference between the two? When do you know to do one or versus the other? How do you have this conversation with your clients?
Yeah, so I think the main thing to take away here is this is an exception to the rule. Most of the time when you put a lot of money in right away, that's generally going to outperform, right, someone who's putting in money over time, right, who's waiting, who's skittish to invest, right? And so why, as you can see here, the purple line is actually above the orange line because 2022 was a down year, right? Over the course of the year, the market went down. So if you're adding money slowly, this is actually a benefit to be kind of doing something like that. But once again, this is very rare. I mean, the amount of times, at least when I calculated this in the book, it's like 75 to 80% of periods. Let's say this is a 9-month period, whatever. If you use 12-month, 24-month, you're going to see roughly the same thing. About 75 to 80% of periods, lump sum will outperform dollar cost averaging, right? Now, obviously, what's the difference there? It's risk, right? You're taking on more risk by doing a lump sum investment, but generally you're going to make a lot more money. So it's something to kind of keep in mind, right? And so how much more? About 5% per year. And if you don't think 5% is a lot, on a $1 million portfolio, that's $50,000. So your client's possibly giving up 50K by slowly wading into the market versus just putting it all in right away.
Yeah, definitely. And I did have another year as an example. I have the 2019 difference, right? So that's a year where the market was actually positive. So when you look at this one, it kind of tells that story that you were just talking about, where that lump sum really outpaces the overall like dollar cost averaging concept here.
Yeah, exactly. And so you're going to probably see something like that. And that's what you would expect over the kind of the long haul, like most of the time. That's the expected result, right? And if you just look at, the S&P 500 in most calendar years is up, 80% of the time, something like that, right? Isn't that right, Rushi? Something like that.
Yeah, looking back, I think it's over the last 30 years, the 1 year S&P 500 total return is positive for 80% of those daily time frames. So 4 out of 5 times you're probably better off just doing that lump sum investment.
Yeah. And so that's the thing you have to think about with your client. Obviously, some are still going to be really worried with risk. I understand like there is a risk of doing this, and that's fine if you want to DCA in, but this is the data here. And we try to, make data-driven decisions, even when emotion is, in a factor as well.
Yeah. And something else we talked about when we were going through this one, Nick, was the fact that this spread, once you're done with that process of actually getting your money in, this spread is the same, right? So if we looked at this chart and went out, 5 years or 10 years, that spread is going to be the same. However, you are going to always be outpaced by the fact that, or by just putting all your money in at once, correct?
Yes, exactly. So the whole idea is like, people are like, well, what about over 10 years, 15? It doesn't matter. It's like, how long is what I call the buying window or the DCA window? How long does it take you to get invested? In this case, it was 9 months, right? Because we're doing $1 million. So it's like you put in 100K and then over the next 9 months, you add 100 each month. So by the 10th month, you're fully invested. And at that point, any difference between the strategies, percentage difference will be retained regardless, because you assume that each of those strategies get the same market performance going forward, right? So it's like the return difference is locked in once DSCA has no more cash to deploy. So that's why you see they kind of are the same, and now they just rotate around that after the 9th month. So
perfect. All right. Well, let's move on to the next topic, which now you've gotten the client's funds, and now it's more of that client being in the accumulation phase. So we have a few examples here. The first one I wanted to talk about was a recent blog post you had, which was the concept of should you save more to retire earlier? So before we jump into the actual scenario, Nick, this was a visual you had within your blog post. Can you talk about what this is showing and how that kind of makes that point?
Yeah, so there's a lot to take in here. So let's kind of do it. I'm just going to pick an example here, and then we can walk through what it means. So for example, based on how much earlier you can retire is going to be based on your change in your savings rate and how many years you are from retirement. So let's say you're 10 years from retirement, hey, I'm at this current rate. If I save at this current rate in 10 years, I'll be retired, right? Just hypothetically go with that, right? So let's say your savings rate was 10%. If you were to increase it by 1%, which is that bottom line there, the plus 1%, you'd retire by about, I would say, 8 to 9 months earlier. That's where it falls on. It's like a little bit less than a year, right? If you were to increase it from 10% savings rate to a 15% savings rate, right? 5% more every year for the next 10 years, you'd retire by, 2.5 years earlier, right? You jump up to the blue line, right? So go from 10 and go from the 10% and just jump up to the plus 5% line. You'll see that's closer to like about 3 years, right? And so that's the thing is like from this chart, you can say, hey, if here's my current savings rate and I know I can boost that by X amount, I can roughly back out how long it'll take me to retire or how much earlier I can retire, right? 2 things to note. any changes from like anyone who has a lower savings rate, any small changes have big impacts, right? Going from, even a 5% savings rate to a 6% savings rate saves you, about a year and a half, right? In terms of how much earlier you retire. But once you get up to like 40, 50% savings rate, saving an extra 1%, extra 5% doesn't really move the needle, right? So it's not that for those people who are already hyper savers, like it doesn't probably matter how much more you save, if I'm being honest, right? Don't over obsess over that stuff. And I think this is kind of giving people permission to kind of back off. But if you're not saving anything, save something, and it's good. Like you save a little bit more, that can help a lot. But once you get to a point where you're saving a decent amount of money, it doesn't really move the needle anymore, right? And that's why you can see all these lines end up converging, even for very large changes. Even when you're like, hey, I'm at 50% savings rate, let's boost it to 60%. You're only going to save 2 years, shave 2 years off of when you can retire if you do that for the next, 10 years, or it would be 8 years in this case. But yeah.
Yeah, thanks for explaining that. And let's go into the scenarios tool to show this from a portfolio standpoint, right? So I have a scenario here saved, which is, let's see here. It's called saving more to retire early. Have a lot here. All right, here it is. So I'm going to go ahead and put in the S&P in this example as well. By the way, I'm using this index just as a point for this webinar, but you can actually put in, if you have a model portfolio created within your YCharts account, you can put in stocks, funds, really any security, and it'll work within the scenario tool, which is pretty cool. But let me go ahead and calculate this one. And to your point, Nick, in terms of saving time, so this top purple line is when you have a savings rate of 10%. And then the bottom orange line is a 5% savings rate. And you could see that as I track through, let's say your goal at the end was, I want to get to 730K, or this is kind of my base case scenario. If you increase that to 10%, you'd actually get to that point right at some point in 2019, like right around here. So this is where you can kind of show that concept of you can retire earlier if that's kind of your goal. That's where you want to get to, right?
Yeah. This is the idea of like, okay, if you knew the exact amount you would need, like an amount, then that's definitely what you can do. Obviously, some people will see this and say, well, Nick, if you retire 3 years earlier, don't you have 3 years more of expenses? And so it's a balancing act, but this is kind of getting at the idea of if you know the amount for sure that will get you through retirement, then that's helpful. But either way, yeah, you can see how much time you end up shaving off of this because of, by increasing your savings rate. And you can just show simple examples of this where you can say, hey, look, you would get to there at this point, and you can add all sorts of different scenarios and different things that would have happened, different life events that can alter this as well.
Yeah, definitely. And again, since we're using the S&P 500, like you could see the growth here, but this might look slightly different for like a 60-40 portfolio, for example, right?
Yeah, this would look very different, right? So I think the thing to remember is like all these portfolios are going to, which portfolio you choose is going to impact this. But yeah, I mean, you can do, and I think you can do custom securities in here as well, right? Is that true?
Yeah. If you are using custom securities and you have your custom portfolio strategy in here, you could use that within the scenario as well.
Yeah, if you have historical data, for example, your client's performance, you can actually put that in there as like as a metric to kind of look over, like over this period, right? And I think that's what's kind of cool is that you can literally feed the data into YCharts and then use that data that you have versus them having to go find it through an index or something. So I think that gives it an edge over some other platforms where they won't even have access to that or have the ability to ingest data.
Yeah, definitely. And in terms of some of the other viewpoints here that you have within the scenarios tool, if you get to the conversation of, well, what does that mean for how much actual money I'm getting out of or how much I'm actually contributing in here, you can go through and look at this bar chart and say, like, this is the amount you would have to contribute 5 or 6 years out and how that grows over time. And then you can also look at a table view of that data too. So if you wanted to talk through this on a monthly basis, quarterly, annually, you can talk through what the returns look like, what the contributions, withdrawals, all of that, and view that within this table too. So it's all pretty useful for that conversation you're having. All right, so next on the list, we have, let's see here. We have a cool another feature from the Ritholtz team. Actually, Ben Carlson, he just posted one called Roughly Right or Precisely Wrong, and he uses the scenarios tool within his blog post. So I'm going to actually queue up the point he was making. And I have this first scenario, pretty straightforward. It's just, dollar cost averaging, going back to your concept of just putting in, initial 5,000. And then I think the point Ben was trying to make was you'd put in 500 every month after that to get to your like 6,000 annual contribution. Is there anything to note here that you would kind of mention, Nick, with this scenario?
Yeah, I think the biggest thing to note is you put in 181,000 and you got 915,000 out. I know it's over a long period. Obviously, it assumes you can hold, and it's 100%, stock portfolio. That's all not really realistic for most people, but still, like, I think this shows the power of what can happen when you're investing over a long period of time. And then this is not, remember, I've done analyses on this, like where you can use different portfolios, you can use different countries, and most countries, even across the world, I've done like international stock analyses, will, outperform, will be above their basis at least, right? And so, and even on an inflation adjusted basis, most of them will at least keep, at the worst case, even some of the worst countries, on places like Italy, Spain, that have had like not the best equity returns in terms of equity markets. When I say the worst countries, I mean equity markets, please, not, I love visiting. So, I mean, equity market returns, like, these places have still kind of kept pace with inflation, which is, don't get me wrong, is not great, but like at the end of the day, like it's better than a lot of other things than just sitting in cash and losing all your money, right? So losing your purchasing power. So there are things to consider there. And so I think that's just a great chart here saying, hey, imagine you started saving at this point, this is what you might have in retirement. And so there you can see that difference. And I think that's what's cool here.
Yeah, and then what Ben does is he takes it a step further. So he takes this final value, which is 915,886. Then he says, what if you took that dollar cost averaging and you changed it to withdrawals? So for this one, same thing with SPY in there. Now you're starting with that 915K, but you're doing a 4% annual withdrawal of that exact scenario. So what is this visual showing you?
So I think there's a couple really interesting things about this visual. So remember this, you start with your $915,000. You can kind of see that, you can see it's between the 0 and the 2 million, it's roughly at $1 million, and you're pulling money out, right? Using the 4% rule, you're doing this kind of over time. And what's interesting is, like, even though you started with 915,000, by the end of this period, by the time you're done with your quote retirement, you've pulled out, 1.75 or $1.705 million. So you've pulled out more money out of the portfolio than what it was worth when you started. You're saying, well, Nick, how is that possible? Because the portfolio kept growing, right? And so in this particular instance, you actually pull out 1.7 million and you still ended up with $4 million, which is like kind of crazy to think, like, wait, I start with $1 million, I got to pull out 1.7 and I ended with 4 million. Like, yes, like this really shows like the power of compounding and growth and all that. And the other thing to note, right? And I think there's Michael Kitces, I always remember this when he talks about like retirees and stuff. You are more likely to, for over a 30-year period, and it was like in a 60-40, I believe, you're more likely to 4x your portfolio than to go below your principal value after 30 years. So like if you start with $1 million, 30 years from now, you're more likely to have 4 million than you are to have below $1 million, right? And that includes, people pulling money out and stuff, right? Using like a 4% rule type of thing. And that goes to show, like, people don't realize the upside. Like, even while you're pulling money out and living your life, like, people's portfolioes tend to keep growing, right? For those who have a portfolio, at least, right? So something to keep in mind. I think this is a very powerful visual for clients. Obviously, the particular scenario will be different for every client, but showing, hey, we follow this rule, this is how much you can pull out, and you'll still have a lot that you can bequest or use for other things in the future. And you could even you could make this and say, hey, what if we make the monthly withdrawals even larger, right? That's another thing to consider as well.
And something else that's amazing about what you just mentioned, I mean, this time frame is 1993 to 2023. So we're talking about the tech bubble, the financial crisis, the COVID recession as well. I mean, there's a few recessions in here, yet you're still growing at that clip, which is really impressive to show that the power in investing in general.
Yeah, I mean, because 2010 was arguably one of the worst periods in U.S. stock history, outside of maybe the Great Depression. And yes, you look over that period, you started that period at what, a little over $2 million, and then you ended it with roughly half, right, while you're pulling money out. So it would have been scary. In 2009, it would have been very scary to say, like, oh my gosh, like, I'm almost back to my starting portfolio value, right? Like, and inflation and stuff, things have happened, right? But you go, you basically get back to almost your portfolio value there. And then yet, look, it's still basically 4x'd from there. So over the course of like, a decade. So that shows like, really powerful stuff, really powerful, tools and things you can show for clients.
Yeah, and what's great, speaking of clients, is you can actually export this into a PDF. And I think that's what Ben did for his post. So for example, he had this screenshot. This is just like a clean PDF report that you can use and show this to clients if you wanted to throw your disclosure on and stuff like that. So that's pretty useful within the scenarios tool as well. Awesome. Well, let's go to our next example, which I'm actually going to go back into the scenarios tool. And oftentimes you get the question of, all right, I'm ready to buy a new house, or I'm ready to buy a car, or I want to spend some of my retirement money or some of my nest egg on something. So how do you answer that question of how much should I spend on a house? And I'll cue this up for you, Nick. I just have the base case in this example, which is, you don't pull out money, you continue to invest, versus you have $500,000 to start off, and a few years out, you actually withdraw out $100,000 to put down a down payment. So that's kind of the setup here. I'll put this one into a 60-40 portfolio, and here's the results that you get within this scenario. So what are you analyzing here? How do you talk through this with the client?
You'll say, hey, like if you don't pull the money out, you don't get your house, this is what your portfolio would grow to. In this case, it would be something like $1.328 million. Of course, if you pulled that 100K out, you see your balance. That's why the purple line drops, from the 500K where it starts, drops down. And you can see over the course, by the time you're done, you end up losing whatever, $300,000 for that $100,000 down payment. Now, you're saying, well, Nick, $300,000 better. Yes, but there's the time value of money. Would you rather have 300,000 in the future, 100,000 today? And it makes it a little bit more palatable what you're thinking about these trade-offs are. And right now you're going to have a home. Maybe there's security reasons, personal reasons you might want that. And it's useful to do this because then you can make that trade-off. You can say, would I have preferred, this much more in the future, or would I prefer this? And of course, we don't know exactly what the future is going to hold, but it's just, we can run different periods, different scenarios where you can test this, right? You can say, hey, let's run it from, let's say 2000, 2010, which is a bad period. And then let's run it from 2010 to 2020, which was generally, or up until the end of 2019, that was generally a good period for US stocks or the market in general. And so you can run it through just a couple of different, like one really bad case scenario, one really good, and then kind of from that conversation come up with like, what's the right plan for your client. So I think that's the big takeaway here. And saying, hey, is that $100,000 worth, getting into a home and having that home? So I have to give up 300,000 in my investment portfolio. And for a lot of people, they would say yes, right? Not everyone would, but a lot of people might say yes. Hey, it's worth that over time. Because remember, the house, that $100,000, in theory, if house prices appreciate, would be higher as well. So this is not exactly apples to apples, but it's kind of approaching it.
Yeah, what you could also do, which I think you talk about in your book a little bit, is the concept of paying rent versus buying a house, right? What that trade-off could be. And you could build that out within here just to kind of pan out what the future would look for your portfolio, right?
Yes. It's a little more complex, and there's technically you have to look into maintenance costs and a lot of stuff like that. But I think one of the things that's interesting is like, housing is done generally well, but stocks have done, far better. But there's trade-offs associated with those things, right? Like, stocks have done much better, but they're far riskier. So it's something to keep in mind when discussing that with the client.
Yeah. Have you come across like a rule of thumb that you've heard advisors use, or some type of way they say like, this is how much you should look at or potentially take out if you would like to?
I mean, everything is so individually specific. It's like such a case specific question, right? And so it's like some people are far more, and it's really about your beliefs too. Some people are far more real estate focused and some are less real estate focused. Like I would say I'm biased against real estate, but I know my bias. I was graduating high school in 2008 and I saw both my parents lose their homes in California. My dad had 2 homes. My mother was doing refis, and it just all, the payment ballooned and they just couldn't afford it, right? So I'm very against real estate, but I think that's my personal bias talking. It is still one of the most prominent way that most households in the United States build and retain wealth and pass on purchasing power to the next generation. So I'm not going to be anti-housing as a whole, but I just know personally I'm kind of against real estate, right? But not everyone's going to feel that way. Some people are going to say, no, real estate's how you build wealth and that's it. So you really need to take into account individual preferences a lot of times. So that knowing your client, I think, is just as important as having the math here.
Yeah, definitely. All right. Well, last topic we have here is preparing your clients for retirement. So this is that last stage of they've done their job, they've accumulated over their lifetime. Now let's talk about retirement and withdrawal rates. So we all know of the 4% rule. Let's just let's talk through that. But before we go into the scenarios tool, I wanted to talk about the markets a bit and give you the floor, Nick, to just, what are your thoughts on in terms of asset allocation mix? And this quilt chart, it's in some of our like visuals. You can pull this from YCharts, but it's basically giving you a visual to show asset class breakdown over different quarters and how it varies so much. So how do you look at this? How do you explain this to clients?
I mean, this is something where you would say like, hey, like the reason we're diversified is because things that do well in one period may not do well in another. There's trends, things like this happen. It's back and forth over time as well. So that's what makes it really tough to be like, oh, hey, I'm only going to do US stocks. I'm only going to do US bonds, et cetera. So I generally prefer diversification. And I think what's useful, what you can take this and actually make this even more powerful by, let's say you took this data and you found like the optimal portfolio, like you do like some sort of solver or something. You can say like, oh, here's what the optimal portfolio would have done. And in many years, the assets that are in the optimal portfolio will underperform like the general market, right? Even when we know like the right answer and cheat, we still know that like a lot of assets that are in the optimal portfolio will underperform. So like underperformance happens. It is regular. It is normal. And some of your assets are not going to be doing well when others are. And it's kind of keeping that perspective and kind of using that information to inform your client like, hey, yes, I know we're invested in, for example, right now, if you had clients investing in international stocks, you've had to have this conversation because they're going to tell you, why are we in international stocks? Why aren't we only in US stocks? This is stupid. They're going to challenge you on that, right? And you have to say like, yes, right now it does not look great. I understand that. I can see that over the last 10 years, but go to the 10 years before that. Look at emerging markets from 2000 to 2010 and compare it to US stocks. Now you're telling the opposite story. Now, as people have said, why the hell were we in US stocks? We should have been in emerging markets, right? So I'm not saying that trend has to continue. Like we don't know the future. I don't know which assets are going to win out. The S&P 500 and US may continue to outperform. We don't know, but it's about like trying to find a balance to that approach. And so that's the thing I would keep in mind here.
Yeah, and definitely. And I think to your point, some of that conversation is asset allocation mix. And the other part of that conversation is them doing their financial plan and actually sticking to a rule like the 4% withdrawal rate, right? So, for this scenario here, if we just open up that 4% withdrawal rate one right here, we can compare two different asset allocation mixes, right? So for example, let's just pull in like a 60-40 mix here, and let's compare that to the S&P 500. So fully invested in the markets, and you can kind of see the difference in the trade-offs here, right, within this chart.
Yeah, very different. And I think what's interesting here is not just like, okay, well, obviously, 100% stock portfolio is going to have more at the end, especially over long periods of time, because generally stocks outperform bonds. But I think what's useful about this is you actually see the risk of this, right? Starting in, when did we start? 2003, right? So you start in April 2003, you can see in the financial crisis, the GFC, like the 100% stock portfolio underperforms at some point 60-40. So even though, and that's where risk comes in, you can say like, wow, at some points, like the 100% stock portfolio would have underperformed. And so it's good to keep that in mind, even with, using the same withdrawal rates and everything. This is a good way to show kind of asset allocation decisions and how they could play out. And once again, I think if I were using this tool and presenting to clients, I would find like, here's a case that shows this, here's a case that shows that, and you can kind of compare and contrast, right? Come up with one scenario that shows, hey, here's when stocks would have done very well, or 100% stocks would have done well, and here's a case where they wouldn't have done as well. And so just having those cases and kind of showing them and saying, okay, what generally happens over time, I think is useful for this type of scenarios.
Yeah, and I'm seeing a question from Richard come in about inflation, which is on everyone's mind right now, right? With what inflation's at, you can actually kind of bake that in here by putting in a withdrawal of 2% if that's your assumption. Or in this case, what I've done is I actually did a rate of change on my withdrawals. So I do have that 4% withdrawal to start off, but that's growing by 2% every year. So now we're actually, if 2% your assumption for inflation moving forward, maybe it's not right now, but long term it is, you could put that in. You could put this at 3% and really let that inflation adjustment kind of impact your overall portfolio value. But let's take this a step further and let's look at now comparing withdrawal rates. So maybe your client's like, you know what, 4% is not enough for me. I don't, 40,000, that's not enough for me to live in retirement. I want to actually pull out 8%. So let's compare those two with this next one, which is the impact of withdrawal rates. And let's put in that 60-40 again. And this one's pretty interesting, Nick. What are you seeing here in terms of the portfolio value over time because of your withdrawal rates being different?
I mean, obviously, you'll just see it's shrinking so much more quickly, right? Obviously, you're pulling more money out, and to the point where the market impacts are, you don't really even see them anymore, right? Because with the 4% retirement rule, at least in this particular example, right? Like you just almost your entire portfolio value is affected by the stock market, right? But once you get to the point where you're actually pulling more money out every year, you're not going to see that impacted as much, right? Because that's what's really interesting about this is like, oh, and because you can see, like, if you keep doing this, like, it didn't run out of money at the end, but it's 132,000, which it doesn't leave a lot, as much for you to pull out. By the end of it, you're like running out of money. And so it's something to keep in mind, is like showing, hey, like 8% might be a bit too much. Maybe you would have to tell your client to kick it back a little, right? Because maybe 4% clearly isn't enough in this case, but maybe they want to find some happy medium. And so it's kind of cool to see like how that would work over time, right?
Yeah, and I can play around with that withdrawal rate too. So maybe you want to say, someone's like, I want 10%. I'm using this money right now and I want to use it every year. And now you can really see that value, or that portfolio value, run out a lot quicker, right?
Mm-hmm. And it's cool to see when that would happen as well, right? It's interesting to kind of play that out over time, right? And I'm thinking, oh, this is showing 8 versus 10. So the 4 is gone. 4 is long gone now, right?
4 is gone, yeah.
This is like, spending a lot and then spending a lot, right? So it's very interesting to kind of to show that over time.
Yeah, definitely. Cool. Well, hopefully that, helps you as an advisor in terms of that withdrawal rate conversation. And it's something that comes up quite a bit, I'm sure, for all of you on the call. So, all right, with that, I think that was the last topic we had to cover, Nick. So I'm going to look into the Q&A. Let's see if we have some questions that came in. Let's see. I have a question about, can you track inflation in relation to portfolio growth? I think we covered that a bit with the, what you could do is actually add a withdrawal here that will basically take care of inflation, or if you wanted to take out 3% of your portfolio to show that inflation adjusted return. And then we have a couple other questions on, can we get access to these scenarios that are on my account? So these ones are on my account, but it's super easy to build these out. So if you have questions on how to build them, or we could potentially push some of these ideas, if you wanted to, just contact your support contact. They'll be able to help you with that. Adam asked, are there any future situations you can run based on Monte Carlo? So we actually do have something in the works to show future returns. It's very close to being out. So a little, I guess I'm giving you a little preview of a new product enhancement, but that should be out pretty soon. It won't necessarily be Monte Carlo, but it'll get you the same type of point or the same result. So Adam, we can definitely connect after the call. I think that's it, Nick. Anything else you want to cover on this tool, on scenarios, withdrawals, retirements, all that stuff?
Nothing on the retirement sector. I think the cool thing is, once you start building out model portfolios, once you start putting in custom securities, you can really take this to a different level. For example, if you're like, oh, I want to just take, I think there was a question, someone said like, I want to take, the S&P 500 returns, but then I just want to take out 2% a year. You can just literally get the S&P 500 returns, in a basic table, create a custom security that literally just removes 2% a year, like just take, minus 0.02 off the whatever the annual return or monthly return, whatever you have. Or in the monthly, you divide by 12, but you get my point. And then you would just upload that, and now you have your, conservative thing. Now takes a little bit of time, but if you reach out to support, they can walk you through it. The templates are very easy to use. This would not take you more than, at most an hour to like put together that data. And at most, if you're a little bit familiar with Excel and stuff, it should be even much easier than that. So that's something you could do, and you can start building out whatever you want, right? In terms of a client's portfolio, what their expected performance is, et cetera. Like you can do all that type of stuff. So that's something I would keep.
Awesome. Well, I think we can wrap up then, Nick. Thanks so much for joining the call. This was great. I'm sure everyone had a lot to benefit from listening to your insights. So thank you, Nick, and thank you everyone for joining the call. Like I mentioned at the beginning, a recording will be sent out to you. So be on the lookout for that. Also, if you're new to YCharts, we got a special promo here with Nick. So mention Nick Maggiulli and you'll get 20% off your new YCharts subscription as well. So thank you, Nick, and thank you, everyone. Have a good day.